You've probably heard this 1,000 times. Buy at support, sell at resistance. But here's the thing. What if the market doesn't respect those levels? What if the chart just slices through your so-called key zones like it's not even there? Most traders panic. They flip their bias instantly. They think, oh, I was wrong. It's a breakout now. And within minutes, they get faked out again. But professional traders, they are sitting quietly. They have seen this movie before. Because that break, that supposed disrespect of your level, is often the signal that the big move is about to begin. So in this video, I'm breaking down exactly what's happening when your perfect levels don't hold, why 90% of traders get trapped there, and how to turn these fakeouts into precision entries that actually make sense. Support and resistance aren't magic lines. They are zones of interest, areas where traders expect a reaction, not guaranteed ones. But here's the catch. When enough people expect the same thing, the market uses that expectation against them. Think of it like a crowded bus stop. Everyone is waiting for the same bus. Same timing, same direction. The market knows this. Sometimes it delays the bus just long enough for everyone to give up or even start walking the opposite way. That's when the bus finally arrives. That's what's happening when your support and resistance fail. It's not that the level is wrong, it's that the market is collecting liquidity. Let's say you've got a clean resistance around 1.80867. Everyone sees it. Price taps it 3 times. Classic triple top. You're thinking, okay, sellers are defending this zone. Then what happens? Price breaks above it with a strong bullish candle. Traders panic, they buy. But right after, the market turns around and tanks 400 pips to the downside. This wasn't wisdom. That's the liquidity grab. The market sweeping out the sell crowd before the actual move begins. So, no, resistance didn't fail. It did its job. It revealed where everyone was positioned, and the market simply needed to clear them out. When price breaks through your level, it's often not a breakout. It's a setup. It's the market's way of engineering liquidity. Because here's the truth. Big players can't enter without counterparty orders. Let's break that down. When traders sell from resistance, where are their stop losses? Just above that level. So, what does smart money do? They push price above those levels, trigger their stops, which become buy orders, and use that liquidity to fill their sell positions. Then price reverses. This is how institutions build the fuel they need to move price efficiently. For example, Bitcoin consolidates at the $100,000 per coin mark. Every time price hits this level, retail traders buy. So when it hits this level, the first time they bought to the upside, it hit this level the second time, right about here, they still bought to the upside. Now, when it got to this level the third time, but instead there was a huge break of this level right about there. Everyone thinks, oh, it's a breakout, I'm selling. So they jump on their sales, and once that happens, watch what happens. Bitcoin rallies back to the upside and stops them out. That wasn't coincidence. That was intentional liquidity engineering. And that's why understanding what's behind the break matters more than the break itself. Here's the key question every pro asks. Was that real intent or was it inducement? Let's break down the trade filters to tell them apart. 1. Momentum. A genuine break has continuation. Clean candles, clear direction, volume confirmation. A fake break usually has a hesitation, long wicks, uneven candles, and quick rejection. If the market truly wants to leave a level, it won't come back in seconds. It will expand away confidently. 2. Structure shift. Ask yourself, did that break actually change the market structure? If it didn't create a new higher high for bullish break or a new lower low for bearish break, then it's not a structural break. It's just a stop run. That's a crucial difference between being early and being wrong. 3. Candle reaction and volume. A liquidity sweep leaves a signature. You will see a long wick rejecting from the sweep zone, followed by strong opposing candles. That's your first clue. The trap is complete. When all three line up, you will see manipulation in real time. And once you start reading this correctly, you will stop getting shaken out of perfect setups. Now, how do pros actually trade this? They don't react to the break. They wait for the retest. Step 1. Wait for the break. Don't enter mid-candle. Let the market finish its manipulation. You want to see the liquidity event first. Step 2. Wait for the reclaim or retest. If price breaks below support and climbs back above it, That's the reclaim. If price breaks above resistance and comes back down to test it, that's the retest. That's where precision entry lives. Step 3, confirm with structure. Don't guess. Wait for microstructure to align. You want to see a shift in order flow. For example, a lower low becomes a higher low. Step 4, execute with confidence. Use confirmation, volume, candle pattern, or market session timing. You're not predicting the move. You are simply responding to structure. And that's how professionals keep composure, even when level fails. Every trader gets faked out, but pros see it differently. They know every failed level tells a story about order flow, about liquidity, about crowd behavior. Retail traders get emotional when a level breaks. Pros get curious. They ask, who just got taken out? Who is trapped right now? What liquidity just got cleared? That mindset shift alone changes everything, because the goal isn't to avoid fake outs. It's to understand them, to read them, anticipate them, and position after them. You stop feeling like the market is against you and start realizing that it's simply doing business. Use this mindset framework to help you out in your trades. Stop taking level breaks personally. Journal fake outs. Mark who gets trapped. Watch those charts next day. See the structure. Train your brain to see liquidity events as clues, not chaos. That's what turns frustration into insight. Let's analyze a live example step by step. I've showed you a fake break. Now let me show you a genuine one. This is Bitcoin, and we've got a level right here. This is a level we have for Bitcoin. And this was the first reaction, second reaction, third reaction, and then this was a break. Now this break happened right about here, and we can see that after the break, Bitcoin continued to soar to the upside. This was a genuine break. Now, how do we know? Structure was obeyed in this break. So we can see that the market kept on making higher highs, higher lows, higher highs, higher lows, and up until it broke this. So after it made that, the market also, the whole distance, the whole movement from this place to this place is what I call a Fibonacci play. Now the Fibonacci play is from here. So this was swing low to swing high. So this was the previous high, and you can see that the market came around to the 50 Fibonacci area. So this is structure. The market came to the point of structure right about here at 50 Fibonacci area and bounced off it and continued to move to the upside. So when the break eventually happened here, this now turned out to be, so this is the break. This now turned out to be a genuine break, and the market moved henceforth to the upside, as you can see right about here. Now, how do we enter this trade? We simply wait for the market to come back to structure. So we just go over to the daily time frame to see this right here. So after the break which has occurred, we are just expecting a pullback to the zone. So once the market pulls back to the zone right about here, now the market has pulled back to the zone there, then we now scale back to the 4 hours to wait for our entry. So our entry, we usually use the counter trend line break, and after our entry was triggered right about here, stop loss comes below and take profits comes all the way here. So mark this zone, guys. So this zone is actually structure still, because if you move from swing low to swing high, you can see this area also coincides with the 50 Fibonacci area, as you can see right about here, the 0.5 level, which is the 50% Fibonacci area, and also it has come to retest this support level. So it's broken back above the support level, and our entry has been triggered. And watch how the trade runs in our favor. So you can see right about here that we've hit our take profit just before the market spun around. If this helped you see support and resistance differently, imagine what happens when you master structure, liquidity, and intent all together. That's exactly what I teach in my Forex Masterclass. It's free, and it's your next step to trading with clarity, not confusion. I've put a link to it in the description. Click on it and learn to trade like a pro. Subscribe to the channel, and remember, when support and resistance don't hold, it's not failure, it's information. Use it.